edition of Investing Education Academy's podcast. We're still in January of 2023, so if this is your first time viewing us, Happy New Year. For everybody else who's already seen us, welcome back. This year, we're coming off just chaos last year. A lot of people, market was all over the place. They didn't know how to invest, what to invest, when to get in, when to get out. It was just a lot of conversation. If you were a member of Investing Education Academy, you would remember that in November of 2021, November 2021 is when we first started suggesting that our members pay attention to their portfolios because the market was changing. If you are not part of an investment group, you need to become part of an investment group. There is just too much information for any one person to follow it all. So with that being said, if you are a member of Investing Education Academy, you're watching this, you're watching the replay, please visit the platform. Things have changed inside the platform. Spend some time looking around because we're still changing things around. So you get to kind of see the metamorphosis of Investing Education Academy while it's happening. And we have a few new Panthers. So everybody knows we have an investment group where we actually invested together, and we're moving into real estate. So for that group, we are now looking at about 12 members. And for all of you all who have followed us for a while, you know that investment group is the highest tier that you can get inside of Portfolio Panthers. Is $5,000 a year. Once we reach 15 members, we are going to stop membership for a little bit. And when we open membership back up, it was going to be $10,000 per person per year. So if you've been thinking about it and you're on the fence, there are literally 3 slots left. We had 2 new Panthers join last week. There are 3 slots left. Whatever, if you come in at the $5,000 mark, you stay at the $5,000 mark, even if membership changes for all new people. But after those 3 slots are closed out, it will be $10,000 per person per year to join the Portfolio Panthers. And we probably will be buying our first domestic piece of real estate next month. So if not next month, it'll be in March. So we're really excited about that. All right, today we're talking about why energy stocks deserve your attention in 2023. Leon's going to tell you why we chose this topic. I'm going to do a little bit of housekeeping.
Yeah, so as Brent said, we are very excited about the new Panthers we have joining. And as a lot of people know, we dipped our toe into international real estate, international lands last year when we bought some beachfront property in Ghana, Africa. We're excited about that. We're going to be moving on, progressing on the building side of that now. We have the land now. We're looking to build something on it.
You want me to show the video?
If it looks like how it did earlier, nah.
Hold up, let me see. This is real time. So
you tell
me.
No. I mean, you can't really. Nah, it's like her. Well, that's not too bad. Okay, so what you're looking at here, people, is a overview of the land we bought. So that house you're seeing is actually our neighbor. Our property is actually two plots to the right. And you're going to see this drone kind of go around, and then you'll see the actual beach, which is a beautiful beach, pristine, pretty much untouched. As I said, now you're looking at it, the property you see in the middle, our property is 2 plots to the left of that. So this is kind of we're actually putting together a video to kind of explain this better, but this gives an idea of what we are purchasing in Ghana. That was straight out of nowhere.
I just happened to be looking at my phone, so I was like, "Oh,
right." I narrated it. I don't think I did.
Yeah, I didn't know you were gonna say that. So
and you held it up good, so it was good. So yeah, so that's that was our first international deal. Like Brent said, we're looking at something domestic now. We're looking to build on that piece of land sometime later this year. Okay, so now today we're talking. Why energy stocks should get your attention. So Brent and I did our I see I'm getting a little bit of a herky jerky there, so I'll kind of go slow. Brent and I did encourage everyone who's part of IEA, who's part either a Panther or an insider level, to go look at this month's hot seat. We put into the hot seat a energy, effectively oil stocks ETF. And we found some some real gems, some companies that are paying over 8 and 9% dividend yields, and stocks that returned upwards of anywhere from 25 to, I don't know, close to 50. Say again?
60. I think one was 63%.
Yeah, I think the highest, yeah, it's anywhere from like 30 to 60% last year. So oil stocks were, and energy stocks were the highest returning last year. And then ending 2021, they were starting to ramp up that year as well. So they were kind of starting to challenge tech in 2021. They totally crushed it in 2022, and going 2023 and beyond, they probably will do well. And I'm going to tell you why right now. So a really interesting stat today. I was reading an article. So for people that don't know, there's a company called Aramco. Aramco. It's the largest. It's either the largest. Well, it's the largest oil company on the planet by far. So it's a state-owned oil company out of Saudi Arabia. Now, anyone who may kind of knows a bit about oil knows that the highest oil reserves in the world are well, they were in Saudi Arabia. Some of that now is actually in Guyana, South America. But I think in general, the largest oil reserves right now are in the Middle East. Saudi Arabia is the largest oil producing country on the planet, and the company that does it there is called Aramco. The head of Aramco came out because there's this big thing in Davos, Switzerland, I believe, right now going on, where all the big wigs around the world go and talk business in the future. And he said that the way, just real quick, the way oil works is, they drill for oil and they produce. So the way oil is actually measured is by barrels per day. That's the way you measure how productive an oil company is. So just take a quick step back. U.S. oil companies, Exxon, Chevron, things like that, based in the U.S. Years ago, they were. So if you look at a chart of oil companies, they were terrible from about 2014 through 2020. I mean, the stocks went like straight down because they were. And the reason they were kind of bad investments was because there's a term Brent talked about it before. There was a term called drill, baby, drill. What that meant was oil companies would take all of their profits. And we all know oil companies are hugely profitable. They take all their profits and plow it back into their business, right? So they look for other places to drill around the world. That's hugely capital intensive. So all those profits were going back into the business. Well, in the late teens, like 2018, 19, 20, investors on Wall Street said, look, you're basically a dying industry. Oil is going to be depleted at some point. We're now moving to renewables and, this whole ESG thing and electric cars and everything. Stop putting all this money into something that's dying and give it back to us, the investors. So what they do, over the last 5 years, they fixed their balance sheets, right? So they went from these hugely highly leveraged companies that were using all their money to drill, baby, drill, and they're taking those billions, hundreds of millions and billions of dollars in profits and now returning to shareholders in the form of dividends and stock buybacks. Well, Brent and I, and again, anybody who's part of IA, Insider, or Panther, I encourage you to go watch this month's Hot Seat Saturday. It's inside the platform. We found companies that were paying anywhere from 2.5% to upwards of close to 4% in dividend yields by these oil companies. Some of them pay upwards of FYI, I bought one today that pays 9.7% dividend yield. 9.7%. And this is the dividend yield that's paid out of profits. It's not paid out of loans, not leverage. It's paid out of profits. So I still have to say, so oil companies are no longer these black holes of where money goes to die. No, the money now is returned to shareholders, which is great. That's why the stocks have been working the last 2 years. So that's the background on U.S. oil companies. Something went wrong. Brent, you still see me? Okay.
Yeah.
Back to Aramco. So the head of Aramco, largest company on the planet between that and Apple, definitely the largest oil company on the planet. He said this week, another quick background. Going into COVID, remember, the world shut down, right? Everything shut down, that including oil production. Oil production effectively went to zero, give or take. And then what happened was when we came out of COVID and the U.S., Europe, Asia, parts of Asia, Africa opened back up, there was an instant demand for oil, instant demand for energy because we were coming out of our cocoons being in our house forever, right? But it takes months, sometimes even years, for these oil companies to ramp up enough oil to feed the world, right? To supply the world. And they're still not there. They're still not back to where they were pre-COVID. So what the CEO of Aramco said today, or this week was that right now there are, and we're talking about in the world, there are 2 million barrels per day of excess capacity that all oil companies around the world have. 2 million barrels per day, right? But he said that's going to go away in the next year or two, and it's going to go away for two reasons. One, the airline industry is coming back online, right? We all are eager to get out. We're traveling like crazy, not just us, around the world. So the demand for jet fuel,
they call that revenge travel.
Right. The whole word is revenge traveling. Yes. And so jet fuel is one of the huge demands on oil. So remember, right now there's 2 million barrels per day of excess oil. The CEO of Aramco said when airline travel gets back to 2019 levels, that's going to reduce the spare capacity the world has by 1 million. So now we're going to have 1 million spare capacity for oil production on the planet. And then he said once China, so now people may not know, China is opening back up, right? So they've got rid of their zero COVID policy, and they're now opening back up. China is the biggest consumer of oil on the planet. And remember, they've been down for like the past 3 years. They're just now coming back online. So he said once China comes back online, that's going to eat up that last 1 million barrels per day of excess capacity. So what does all this mean? It's business 101. When you have more demand than supply, the asset goes up, right? So over the next year and a half, there's going to be more demand for oil than is oil production or oil supplies. And so what does that mean? That means these oil companies, these oil stocks we're talking about today, are going to most likely do very well out in the future. And he's basically saying like this is I don't say perpetuity, but this is like over the next 3, 5, 10 years is going to happen. Because again, there's just not enough oil. There's not enough oil capacity. There's not enough drilling. There's not enough production happening on the back end to supply the world's need for oil. And so this is going to push up. He's going to bid up the prices of oil companies because their profits are going to increase. What does that mean? They're going to start paying out higher dividends and have higher stock buybacks. And all that's going to do is push up these stock prices. That on top of the fact that these companies are now very well run. As I said earlier, they've cleaned up their balance sheets. They're no longer drill baby drill. Before they had a huge amount of debt because they were doing all these loans to buy drilling equipment, to buy tons of drilling equipment. That's more or less gone. So all that money that they're getting,
Also,
they're returning to shareholders,
real quick,
and that's going to happen more in the future. Mm-hmm.
You should also touch on all of the reduction that was done with BOE in all of these oil companies during COVID. Like,
wait, what you mean?
Like, I know a lot of the companies reduced their business overhead expense by like 20, 25, 30%.
Oh, yeah.
All the people that were just on the balance sheets because they were friends to somebody, they're gone.
Yeah. All the like the cronyism, and there was a lot of cronyism in oil. A lot of that is gone. And yeah, to that point, these companies, even during COVID, I mean, every company during COVID got leaner to some extent. Some of them didn't, but some of them got leaner where they could because they kind of had to. And when your revenues essentially go to zero, like what happened to oil companies because they couldn't drill because everyone was home, they saw where they can cut the fat and kind of purge where they need to. Now that the world is coming back on, they're essentially bringing back on just what they need. There's no longer that fat, and again, that lends to why these companies are so much leaner and have so much more profits to pay out to us, the shareholders. So this is why the thought on Wall Street. So remember, over the last year and a half, oil energy stocks have led the market. We're used to tech. Tech has not been the leader the last year and a half. It's been since let's say like mid 2021 through today, oil has been by far the leader. And as I said, the head of Aramco, the largest on the planet, has said the supply of oil is going to way undershoot the demand going forward, especially over the next year and a half. So Brent and I did our hot seat on it this month on energy stocks. And we're now kind of sounding the alarm now. Like there's something you want to a train you want to kind of get on now because you don't want these things to start running up and you're left behind waiting for tech stocks to come back. Which I'm not saying don't get in tech. I'm still in tech. I'm still buying tech, but I am definitely committing a larger percentage of my portfolio to energy stocks than I ever have. So just FYI, definitely look at energy stocks, particularly oil companies. To add to your portfolio going into 2023. Don't just think blindly buy tech. Don't do that.
Yeah, and I just for fun, I don't know how many of you all know this, but when you get on a plane, you're talking about gas costs anywhere well over $15,000 just to get you where you're going in a lot of cases on average. So these, and you just look across out the window and how many planes you see pulling up and getting gas, and you're talking $15,000 a pop. So this is something is very real, and it's more people. And this is with the partly closed down U.S. and some areas of the world that have not allowed visitors.
I mean, China's perfect.
Yeah.
China is just now opening back up, and China is the largest consumer of oil on the planet. So imagine a year from now when China's kind of rocking and rolling and back to normal, where the price of oil is going to be, and then where the price of these oil companies are going to be. So, and like I said, these companies pay some very, 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 very nice dividends, well over 3, 4, 5%. Like I said, I bought one today that pays 9.7% dividend yield. And I will be letting, by the way, the Portfolio Panthers what that was. And I did some other buying today too, but I'll let the Portfolio Panthers know what that was probably tomorrow.
So for everybody who's thinking, oh, great information, I love seeing you all, use this information. Again, go back to November of 2021 and listen to one of those 4 podcasts that we did. We literally announced that the market was changing and you need to look at your portfolio. Even for myself, Leon will tell you this, I was a huge proponent of single stock risk because I knew what I was doing, and even getting decimated in the short term from having single stock risk, I'm talking 45% in just one company alone. I still had an overall average rate of return over 1,000%.
And why is that? Because you bought
a long time ago,
right? You were in the market a long time.
Yeah. So when you have a long-term outlook and I'm hedging my bets. I'm not just buying single stock risk, not, having dollar cost average into this stock for a long time. And I still won very big. So anyway, the point is this. There's a lot of good information in these podcasts. And I know me and Leon are people jumping on tables and we're not screaming at you. We're not pointing to all these things lighting up on the screen, but we have really good information, and you can choose to listen or keep watching the videos of us buying land all over the place thinking, I wish I would have done it. And we're extending an offer because as you all in this year, probably you're going to see us doing a lot of things we weren't doing before. You were looking at private equity deals. We're buying into startup companies. We're doing startup funding, I should say. It's going to be a very different Investing Education Academy group than it has been in the past. And we're just going to continue to get bigger. So, we hope you take the ride with us. So with that being said, we will put our stock picks into the platform, and we will see you all in 2 weeks, not next week, 2 weeks. So for everybody here, this will be our last Happy New Year because I'm doing it throughout January. After that, it's business as usual. So let's get to it. Let's make some money. 2023 should be a very profitable year if you position yourself the right way.
Oh, real quick. Last thing. Sorry. Last thing. Just want to cover real quick on, of course, the
PPI.
Inflation, right. So today the PPI came out, not to be confused with the CPI. PPI is the Producer Price Index. It came out today, and this is actually more, and not more important, but it's kind of a leading indicator on what the CPI could be. So the PPI is what wholesale companies pay for goods, right? So and wholesalers put all of our stuff together, and then we buy the finished product. So if they're paying high prices for the input costs, cost of materials, the end product is going to be more expensive too. So if we see PPI coming down, that's really good for general inflation because that means the price of goods will come down. Well, today PPI came out. It was expected that PPI would be down 0.1%. Sorry, 0.1%, but PPI was actually down 0.5%. So it was a huge outperformance in how much inflation came down for wholesalers, which is great because again, that's going to feed into the CPI, which feeds into everything that we buy. So the last 2 months, that's the last 3 or 4 months, we've seen really good data on inflation. It's coming down. What the Federal Reserve is doing by raising interest rates is working. Now, of course, the market doesn't like it, but we got to kind of deal with this for now. But as long as inflation continues to drop, the market will be able to absorb these interest rate hikes, and eventually the Fed will stop. Like I said, I'm predicting the Fed will stop by mid-year, by May, June will be the last raise, and then they'll just hold them there for a while, and then we'll kind of see how the economy works. But so far so good. Inflation is looking good, especially going to New Year. PPI came down. CPI last month was way below, came in way better than was expected too. So as Brent said, hopefully this year we're looking for this year to be a profitable year in the market as well as other places. But inflation is cooperating is the message.
So with that being said, we will see you all in 2 weeks. We thank you for continuing to follow us, and we hope this information helps you and your family.